Let's welcome on board then Vipul Prasad. He as well joins in. Vipul, afternoon. Today the story has really been around crude and the kind of cool-off that you're seeing, the fact that OMCs have recovered quite significantly, and you're seeing it being felt on some of the aviation stocks as well. How is it that you plan to approach the crude cool-off? Any stocks and themes that you're betting on which would be sensitive to crude oil price movement?
Good afternoon. Good to be here. So, yeah, the way crude has been coming down, firstly, it does impact a lot the way our fiscal deficit and current account deficits are shaping up. So that's the best part for the entire market, Indian market, in that sense. When we talk of sectors, yes, airline can be a big beneficiary, but there are bigger problems in the airline sector, so probably worth staying away from there. At least we won't touch it. There are some other sectors. For me, the biggest beneficiary from not exactly oil, but a byproduct of oil could be some of the paint stocks. So something like an Asian Paints would look good in this context.
Okay. Oil marketing companies, what's the approach there?
Oil marketing companies, again, I'll want to stay away right now because, see, oil has definitely, crude has, Brent has fallen down to $65, but we still can't be sure if it will hold here. So in the next 3-4 months, if for some reason OPEC decides to cut volumes for some reason, 3-4 months down the line, if oil again shoots up to say $75-80, and as we approach the elections, we are not sure how will the government behave as in like how will they try to approach the petrol and diesel pricing, because if they decide to cut prices, oil marketing companies also may have to take some loss there. So that's why probably avoidable at this point in time. It'll at best be really strong trading bounces, but not sustainable, at least not in the next 6 months, because regulatory pressure will be there, regulatory risk will be there on the horizon.
Okay, fair point. In fact, let's really analyze the crude price cool-off and what has caused it. What are the repercussions now that crude oil has cooled off significantly, sub that $65 to the barrel mark? We're calling it the crude reboot, and my colleagues join in to get us a 360-degree perspective on the same. Jayesh, let's begin with you first. What has caused the fall in crude?
So if you have a look at the screen right now, oil prices are currently trading with a positive bias, but that is after the 6.5% down move that we saw in the overnight session. Now with yesterday's move, what has actually happened is WTI in fact has declined nearly 30% over the last 34 days. A few reasons that we have picked up for this fall. One is that the investors have in fact moved out of riskier assets on the back of escalating US-China trade war concerns, and the other one is that there is increased uncertainty over OPEC's output plan cuts. There's of course one person who's extremely happy about the lower oil prices, and that is US President Donald Trump, who has in fact gone on record to say that Saudi Arabia has been very responsive to his request to keep the prices lower. And also Trump has mentioned that the Saudi prince will not be punished for the death of Jamal Khashoggi, the journalist, so that is the positive for the oil markets. Now, as far as what you have to watch out for is, of course, the Vienna meet. OPEC and its allies will be meeting early in December to decide whether some of the cuts need to be put in place. However, the International Energy Agency has warned that in case of any supply cuts, that would in fact be negative for the oil market. So, all eyes on the OPEC and its allies meet in Vienna upcoming in December.
Okay, Jayesh, thanks very much for getting us that update. In the meantime, finance ministry sources welcome the crude fall. Ruchi joins us with what the North Bloc is thinking about this reversal, and they would be a happy lot, Ruchi.
One of the biggest headwinds for the Modi government was, of course, the high oil prices. When oil prices reached close to the $85 per barrel mark, and not just that, it had a ripple effect on the entire economy, given the fact that India is a net importer of crude oil, and also we saw the rupee falling as well, and that kind of put the government in a sort of a fiscal jeopardy. But now with the oil prices falling quite a lot, oil below the $65 $65 per barrel mark, hovering close to 62, 63. It kind of shows that in terms of the macroeconomic worries that the government had so far, that are well taken care of. The fall in crude oil prices, as well as the fall in rupee, and the rupee also stabilizing, somewhat gives confidence to the government that they will be able to rein in the current account deficit. Right now, with the high crude oil prices, the worry was that the current account deficit could settle in for FY19 between 2.8 to 3%. But now with the oil prices falling, the expectation is that for the year end, we will see current account deficit between 2.2 to 2.5%, and Finance Ministry is welcoming the fall in crude oil prices, and they believe that it couldn't have come in at a better time when the government is facing assembly elections in various states.
Ruchi Jayesh, thanks much for really highlighting what's going on with crude prices. But we don't see a further sharp fall in crude prices. That's the word coming in from David Lennox of Fat Profits. He adds that the December OPEC meet will be very crucial for more cues for the liquid gold.
So we think at this stage it's too close to that December meeting now. We've heard rhetoric, and it's been opposing rhetoric, getting closer to the meeting. We've heard it being suggested that there certainly won't be cuts. So from that point of view, we now really are probably going to ignore most of the rhetoric and just wait to see the actual outcome. And then, of course, the markets have seemed to be falling back into that old pessimistic way about OPEC, that what they say and what they do are two completely different things. So if we go back down that road like we had for many, many years been on, then the oil market's going to be very volatile going into the close of 2018. We've kept our 74 to 84 price range for Brent, primarily because it is a bit close now to change it to any other number. But we do think that perhaps cuts are more likely than we can see increases in production out of OPEC, and that should stabilise the oil price.
Okay, let's take that discussion forward. While we've already got Vipul's view on how he plans to approach crude, I'm wondering, Vipul, what's going on with the IT and the kind of incessant selling that you're seeing? Infosys is already testing its 200 DMA. You've got TCS as well, which is down. In fact, the entire Nifty IT index and its constituents are under pressure. Do you think IT may have topped out as a trade or investment?
In case of IT, the biggest driver, apart from the fundamental ones, had been the way the rupee had been depreciating. So now that largely driven by crude to some extent, and also because of RBI interventions, rupee has been appreciating. So in that sense, the gains that were visible for IT companies, that are gone to that extent. But having said that, there was a fundamental reason also for the way the IT stocks behaved in the last 12 odd months. So, but from here on, I'll also be quite skeptical about the return expectations from IT stocks. 2-3 reasons. Firstly, most of these IT companies were benefiting a lot from, rather even now, they've been benefiting a lot from the state of the US economy, the way they've been booming. So that has meant a very strong deal flow that has been happening for IT companies. And on the digital front also, they have been doing well. So earnings have been delivering positive surprises all along. But from now on, it's not going to be so easy because US market looks like it is already topping out, the market economic growth. Also, the US Fed rate continue to go up. And one more thing that is worth keeping in mind is that in 2017, the kind of valuation window that was available for these IT names, that is no more there. So they are no more cheap. So that's the reason why probably money is finding its way out from IT to some other sectors. So in my view, probably at best neutral expectation should be there from these names.
Okay, fair enough. That's a quick call coming in on IT. I just wanted your view on Maruti Suzuki. I mean, the stock has pretty much not had that much momentum of late post earnings, 1.5% higher in today's session. What are you recommending to clients for Maruti?
See, if we are taking a longer term view, because obviously it's very difficult to take what's going to happen in the take a call on what's going to happen in the next 3 to 6 months. But if someone can afford a 2.5, 3 years view, I think Maruti would be a very good stock to own. Firstly, it is a direct play on rising disposable incomes in India. Secondly, from a company perspective, most of its competitors are finding it difficult to survive at the existing levels. Maybe 1 or 2 years of competition is there and then they fall off. So the kind of well-entrenched distribution system that they have, the kind of connect that they have with the Indian markets and the kind of branding that they have, I would say that they would continue to grow at a faster pace than the market, auto market growth in India. And on that basis, from a 2.5, 3 years view, it looks quite good.
Okay, fair point. Pharmaceutical though, that's really turning out to be the story today. You've got DRL, which is spiking up a good 6.25% after getting that nod for generic Suboxone. You're seeing quite a bit of move come in DRL. Aside of that, telecom also continues to be a good theme. Holding up 6% up in the green right now for Idea. And Vipul, you know, telecom really has come back to the fore in that sense after Bharti Airtel held their analyst meet and they indicated that ARPUs may have bottomed out. Considering how beaten down and under-owned the segment is with the incumbents, both Bharti and Idea, would you relook at them for, from an investment perspective?
I would say we are still some time away from a situation wherein we can say that yes, some of these names can be bought. 2, 3 things. Yes, the intensity of competition or the pressure on ARPUs has gone down to some extent. It is true that to some extent ARPUs have bottomed out, but the bigger question is, are they going to see a rebound in ARPUs? I would really doubt it, because unless you see a rebound, the balance sheets are not going to start getting into a state of repair, because balance sheets are really troubling for any investor. It'll always be in the minds, as in like what is going to happen in the next quarter and the quarter after that. So every quarter is going to mean a lot in terms of earnings for the balance sheet direction. So I would still think that we are some time away from a situation where we'll say that okay, worth looking at it, especially given the fact that they have performed quite poorly and so much of negativity is there around these two, 3 names. So that's the way I look at it.
Okay. Stay on, Vipul. Tata Steel MD and CEO TV Narendran says China growth slowdown is affecting prices, sees strong demand continuing for the steel sector.
I think there is obviously some concern about China, maybe a bit overstated at times, but there is a concern. If you look at it at a macroeconomic point of view, China is growing quite well at 6.5%. What has slowed down a bit is the auto growth in China has slowed down. The growth in appliances is slowed down, but the growth in the real estate market is still quite strong, right? So hence you're seeing the impact more on flat products, which is more dependent on auto and appliances, than in long products, which is more dependent on construction. So there's been a little bit of unwinding of positions in China, and there's also a lot of speculation going on the cuts in China, and there is a view that the cuts announced by the government is less than what people had anticipated. So we've seen the flat product prices soften by about $30–40 in the Southeast Asian markets. As far as its impact on India is concerned, I'm hearing of import parcels being booked into India. It's not that because the domestic prices are a bit on the higher side compared to the import landed prices, because when you import you run the risk of having material come in 2–3 months after you book the order, unlike in domestic where you get it immediately. So that's playing out. So as of now, the imports, I'm told, in December is forecasted to be about 600,000 or 700,000 tons. So there will be some sort of impact of that in the domestic markets, but I'm positive given the fundamentals of the Indian economy, the fact that the economy is still quite strong, and I hope the prices stay up. It's our job to make sure we get the best prices we can.
Tell me a bit about pricing. Where is the power? Which sections of the product lineup do you see more premium when you're talking about flat products actually seeing some pressure at this point?
So the long product prices have been more stable than the flat products, and long products again depends a lot on the infrastructure activity, and a lot of spending continues in the infrastructure space, and we believe that a lot of it will also happen as a prelude to the elections when a lot of activity will happen there, right? In terms of flat products, again, India is different from the international markets because auto demand in India is still quite strong, right? For us, obviously, from a Tata Steel point of view, our strongest franchise is the B2C business, which is 20% of our revenues, where we really sell through a distribution network and reach out to individual customers who buy Tata Steel because they trust Tata Steel, and they're not customers who are looking at what is the international price. They're consumers who want 3 to 5 tons of steel, and they are happy to pay a premium for Tata Steel because they trust Tata Steel. The other big franchise for us is the automotive franchise, which is about 20% of our revenue, where again quality is more important than anything else. So it's not about what is the cheapest steel available, but who amongst the quality producers can give me the best price, right? So you're competing with 3 or 4 people in India and globally. And there again, an auto company typically looks for stability of supplies, stability of quality. So I think these are 2 of our strongest franchises, account for 40% of our revenues. And in the 10-15% of our revenues comes from our downstream business, which is our value-added products, services. So that again is reasonably stable. So that's why Tata Steel tends to have numbers which has more stability than some of our peers because we have fairly strong franchises in these areas, and also the fact that we are able to sell most of our volumes in the domestic market is indicative of the equity that we enjoy with our customers.
Okay, that's the word coming in from the Tata Steel MD. Let's move forward and talk about what else is happening. And clearly the 2 defining trends today is the IT weakness, and selectively you're seeing pharmaceutical and aviation stocks actually hold out. CK, I know you've got a sell call on KPIT, but what generally as a trend are you picking up on IT? Because this seems like a big reversal. Is it really that, given that Infi as well has challenged its 200 DMA today?
Well, it certainly is looking a bit worrisome for IT stock, because if you look at it in the context of the rally that the whole market has undergone, most of these stocks are nicely above the end October lows that we had seen when the index itself was close to 10,000. And in contrast to that, if you look at the IT index, that is now coming down to actually challenge the 26th October lows, and it is the only index doing so. Even, if you look at the rest of the sectoral indices, you may not actually see that as a feature. And leader stocks are, moving down. Infi is down, TCS is down, the mid-cap pack is down. So I don't think collectively that looks very good. And if this keeps up, there's a fair chance that the Nifty IT index will actually make new lows, which will be even below the last month lows.
Yeah, we are clearly seeing that index showing a lot of weakness. You can read it in a lot of ways. You can paint a currency picture, or you can say that risk on is on because IT is considered as a defensive name, and probably banking is doing well, and if IT is not doing well, then that's not such a bad news for market. But there is one more space which is showing mixed reaction, and it's NBFC space. And Vipul, I want to come to you on that space. Now, to whomsoever we ask about fundamentally which space within NBFCs is looking good, so we get the usual names like HDFC Limited or Bajaj Finance of the world. My question to you is something which is not getting recommended, or something which is mentioned that to stay away from: Indiabulls Housing Finance and Dewan Housing Finance. Now, these 2 names, we understand there was a problem. There were a lot of issues pertaining to the credit worthiness as well. And 2 crucial months people were waiting for October and November to get over. And November is also, almost behind us. And we haven't seen any major, damage seen in terms of news flow. What's your opinion on NBFC space at large, and especially these 2 names? How should investors who are stuck in these stocks at much higher levels, how should they respond?
See, firstly, I'll talk more about the sector rather than specific names, and I'll take the last question that you had, that one first. Rather than an investor, rather than looking at his entry price, he should look at his expectations versus the current price. So, because it's a sunk cost. If you bought something at $100, it's down at 30. If you're waiting for the 30 to go back to 100, probably you'll do a big damage to your own portfolio. So that's the way one should look at it. In terms of NBFC, all along I had an impression, I always used to think at times that it was a bit too good to be true, that the growth continues to be 35-40%. If you're less than that, probably you're not doing your things properly. And the NIMs were quite healthy as well. So at some point in time, something had to give way. Having said that, does it mean that NBFCs are not going to revive? Definitely no. Many of them have very good parentage, very good balance sheets, and very good business models also. To some extent, many of them have been impacted because of the news flow around the sector. But one thing is for sure, next 6, 9, 12 months also, the growth has to come down to more normal levels, more like what some of the best banks are doing, or maybe slightly higher than that, because the kind of risk that NBFCs take, they are slightly higher, so growth can be slightly higher, but it can't be a 20% premium over the best banks. Secondly, even the cost of capital, that has to go up, and I would not say that this is going to go up only for the next 1 or 2 quarters. So basically your margins are also getting compressed. So in my view, worth staying away from, unless you are looking at some sort of a trading bounce or something. That's actually not my domain.
Okay, we'll take a break on that note. Stay on with us, Vipul. When we come back, last hour almost to go for trade to close. Get you the closing trades. The news of the major exits that have come through. Vipul, how are you reading the story on Yes Bank? What's your call really among private banks? What's the pecking order?
Amongst the private banks, actually, it's HDFC Bank and Kotak Mahindra Bank, and probably that's it for us in terms of buying. As far as Yes Bank goes, I think there is too much of news flow, and on a daily basis we are seeing something or the other. So worth staying away. Of course, we have seen that the pullback also can be quite sharp, but are we playing for that? That's a different thing. That's why I'm saying that but from a fundamental perspective, there also are question marks on the loan book and the asset quality. So, and on the top of that, MD CEO departure and search for a new MD CEO. So all these things are making it very volatile, for at least for our appetite. We'll be happy holding on to HDFC Bank or a Kotak Mahindra Bank, wherein at least every year, if not every quarter, you can be assured of 18-20% growth in loan books. You have a very strong loan franchise. You are not into project financing, and also the CASA ratio is quite high, which means your cost of capital remains low. You are consistently able to deliver 4% plus of NIM. So NII growth definitely is likely to come around 20%, if not more. So with such size stocks, which are not so volatile, probably no harm in having one of these two in the portfolio, because they also provide stability to the portfolio.
What is your apprehension related to ICICI Bank or Axis Bank, and why they are not figuring out in that list?
We have seen some rebound with good reasons also, that we have seen some development on the loan book cleanup. But I would still say that, and especially with the way the IBC has worked out, although there have been some delays versus what had been expected, or versus 270 days, some cases have been dragged on for more than that. But still, I would say IBC has been a fair amount of success, and much more fruits will be seen in the coming quarters. But for ICICI Bank and Axis Bank, I would still say that we have not yet seen the peak. And especially in terms of losses, so in terms of provisioning. So I think at least 2-3 quarters it'll be worthwhile to wait out.
Okay, Vipul, great to have you on the show. Thanks so much for taking the time out and joining in.